Hey guys, Jag here. We've seen the likes of Coinbase, Deliveroo, and other companies IPO in the past. But what exactly is an IPO? What's the point of these companies listing on the stock market? And how should you approach this to ultimately make money and manage your risk? Now, none of what I'm about to say should be construed as financial advice by any means. But let's get down to the bare basics and then go to an increasing level of difficulty where we can actually discuss potential money-making opportunities. But first we have to understand the difference between a public company and a private company. Surely you can just buy shares in a private company as well. So what's the whole deal with this IPO stuff? Well, the problem with a company being private is that it's not as easy to actually buy and sell shares. Let's say you wanted to invest in Gymshark, which is currently a private company, not on the stock market. Now, for you to do that, you would have to contact Ben Francis. He would have to agree to sell his shares to you, or he would have to issue you new shares in the business. And for obvious reasons, as this company gets larger, this process won't be viable for small investors. So when a company becomes public, it's essentially listing itself on an exchange where everyday people can sort of buy and sell shares pretty quickly. Now, along with other reasons, there's actually two main reasons why a company would become public. One of them is not in your best interest. The first reason is that it wants to expand its operations. The company is becoming larger, it needs new warehouses, new factories, and it needs money to do all that. And even the current profits they're generating in the business is not really sufficient for them to expand their growth. So they issue shares in the business to the public in exchange for money. Now, the second reason is that people that invested in the company while it was private want to sell their shares at a higher price so they can reap the rewards. See, the way it works is that when a company is in the growth stage, it goes through a series of fundraising events where venture capitalists, sort of like dragons, invest in the business. Now, these venture capitalists want to make money as well, and the only way to do that is for them to find buyers for those shares. And obviously, as we discussed before, it's very difficult to find buyers for private companies, especially if the company isn't doing that well. So it may become really easy for them to just liquidate their shares, sell their shares on the public market as soon as it hits the stock exchange. Now let's take Coinbase as an example. Gary Tan, who's an investor, venture capitalist, invested $300,000 into Coinbase when it was in the growth stage. Now, as the company has hit the stock market, Gary Tan can sell his shares quite easily. And obviously now he's able to sell his shares at a premium because now buyers are willing to pay more for his shares because Coinbase is now at a higher valuation. Now, in Gary's situation, by Coinbase entering the stock market, his initial $300,000 is now worth around $2 billion. Now, this sounds all legit, but I initially said that this might not be in your favor, and here's why. Not all companies are created equally. Now, there are loads of companies where venture capitalists have put money into that are not doing as well as they thought. They start to make a lot of losses and nobody wants to invest in them. So sometimes venture capitalists can think that, I've invested, hundreds of millions in this company and it's not going anywhere. What do I do? So going public may be an easy way for them to offload all their shares to, public buyers who may not have done the adequate research to find out that it's actually a loss-making or a mediocre company. Now, before I give you an example of this, be sure to hit the like button, subscribe if you want to see more videos like this. It does really help out the channel. Anyway, let's get back into it. Now, we don't have to look very far to see when IPOs have failed. Now, one example of this is Root. This is an auto insurance company startup which failed to live up to the hype. The company went public in October of 2020, but since going public, the financials of the company haven't been looking so good. They reported a 50% decline in revenue, and in the last 6 months, the stock price is down around 60%. Now, what that means is that if you had invested £1,000 on the IPO day, your investment would be worth around £400 now. Now, this doesn't mean that it's going to stay at this price for a while. It just means that there was a lot of hype involved when investing in the company at that specific phase of its growth. Now, what happens when there's a lot of hype? People end up overpaying, which is what sort of happened here. Now, there are a bunch of legitimate reasons why a company would IPO. After all, it gives them more credibility. If a company's on the stock market, people would trust the company more. Now, all of this is great, but how do we actually make money in an IPO? After all, if we can get involved with a good company in the early stages, then we can stand to make a huge profit down the line. But to do this successfully, we need to have some sort of game plan, some sort of strategy. the first thing we need to do is analyze the company financially. Is the company making money? What are the future prospects of that given company? Now, as part of the IPO process, a company will have to issue an S1 form in the US. Now, different countries will have different equivalents of this, but what this will show is a lot of information about the company. Now, using this document and seeing what's happening around the industry, you can decide the max price you're willing to pay for that specific company. Let's say you decide that based on the industry and where the company's going, Coinbase is probably worth around $80 billion. So depending on the number of shares being issued at the time, you can actually decide that, I'm not going to be able to pay more than £200 a share. Now, once you've figured out the company's sort of fair amount, stick to that. The reason is that with IPOs, there can be a lot of media hype. The last thing you want to do is overpaying for it. Let's take Deliveroo as an example here. A lot of FOMO was happening here. Now, they allowed 70,000 customers to buy its stock before it IPO'd. They did this through a platform called Primary Bid, and they allowed customers to only spend between £250 to £1,000. The price was locked in at £3.90 a share. Now, when it actually came into the market, the stock sank to £2.75 a share. Now it's around £2.50. That means if you had invested in that phase, you would have lost some money. According to CNBC, Deliveroo tempted customers to purchase its stock through advertising on its mobile app and actually sending them emails. Now, this is all part of IPO marketing, and you should ignore it for the most part. If they're saying they're worth £3.90 a share, just ignore it. Figure out your own valuation of the company and the price you're willing to pay for it. As soon as you found out the price you're willing to pay for it, here comes the fun bit. So now you can actually use a limit order to actually limit the price you're willing to pay for that stock as soon as it comes into the market. Let's say you set a limit order at £2.30 a share and it opens up and it's rising to £5 a share. Your order will not execute and you won't be forced into buying at a higher price. If you don't choose to do this and you're diving into a market order directly, then this can be very costly for you. The reason is that when a stock launches at its IPO day, it is very volatile. So your order might be filled as a higher share price than you expected. Now, IPO investing, along with a lot of things, can contain a lot of risk. But if you play it right and you don't listen to the hype and you actually do your fundamental analysis, then you do stand to make a good profit in some occasions. Now, IPO investing can be one way of investing in an early stage company, but another way is called crowdfunding. For example, those who invested in Revolut's crowdfunding campaign made around 1900% profits. But this sort of investment strategy involves a whole nother mindset. So if you want to check that out, be sure to check out my video here when I go through the whole process. Anyways, thank you so much for watching. Be sure to smash the like button and subscribe if you want to see more videos like this, and I'll see you in the next video. Thank you so much for watching.